Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 919A, and today's date is March 15th, 2016, and the title of the episode is The Central Bankers Continue to Manipulate the Economy as it Contracts into a Collapse. Let's get right into the economic collapse financial news. Now, we're seeing the market continually fluctuate, and the market is not really any type of indicator of how the economy is doing. This is the government, the central bankers' tool to try to convince everyone that everything is fine. Because in their minds, if they keep this alive and they keep this pumped up, everyone believes the economy is doing well. But this is not something that we need to look at because the market doesn't show us anything. Because it's one big game, it's manipulation, and it really doesn't show the true picture of what the economy is doing. So we look at other indicators. And we've noticed that a lot of stores are closing. Men's Warehouse, Sports Authority, Macy's, Sears, JCPenney's, Barnes & Noble, on and on and on with the list. And we're starting to see that retail sales are continually contracting. And we see that retail sales have dropped about 0.54% in the last 2 months. This is the biggest sequential drop in a year. And retail sales down most in a year. And when we look at this, we see that retail is in a downward trajectory. And it is very weak in the recessionary levels, and it's getting weaker as time goes on. And when we look at what is happening here, we can see that many of the key segments in retails, they're posting declines. Motor vehicles is down negative 0.2%. Furniture and home furnishings down negative 0.5%. Now you would think that would be up since, housing market and real estate is booming. Well, this shows us that no, it's not booming because this would be up just like we saw prior to 2008, going back where people were buying a new house, they like to get new furniture, they like to furnish their house. And we're not seeing this whatsoever. Electronics are down negative 0.1%. Food and beverage down negative 0.2%. Gasoline prices have come down, so that's down negative 4.4%. General merchandise is down negative 0.2%. And online sales, of course, everyone uses this excuse that no one is shopping in the brick and mortar shops. Everything's going online. But again, this is not true. Online sales are down negative 0.2%. So what we're seeing right now is that retail is continually contracting, sales are not picking up, and we're seeing things completely fall apart. And we're going to see more stores come out and say, okay, we can't do this anymore. We need to close stores. We need to lay off people because the economy isn't there. Now, out in the subprime auto arena, where they've been pumping up auto sales, and they're giving loans to anyone that has a heartbeat, we know that the subprime auto loans are being packaged, just like when we had the subprime securities in housing. They're doing the same exact thing. And what we're seeing right now is that delinquencies on the subprime auto debt packaged into securities reached a high not seen since October 1996. Late payments continue to worsen in February, and this is according to Fitch Ratings. The number of car borrowers who were more than 60 days late on their bills in February rose 11.6% from last year, bringing the delinquency rate to about 5.16%. Fitch wrote on Monday in a report, during the financial crisis, delinquencies peaked at 5.04%. So we're at 5.16%. During the financial crisis, we hit 5.04%. Now, what's very interesting is that these economic indicators that we are continually looking at, we are passing the 2008 crisis numbers, and things are dramatically accelerating to the downside. And if you notice, as more and more of these economic indicators come out, the numbers are consistently moving downward, which tells us the economy is not improving whatsoever. Now, when we look at the U.S. business inventory to sales ratio, we see that total business inventory sales rose about 1.40. This is the highest since May of 2009, with a 0.4% slump in sales and a 0.1% rise in inventories. This tells us that the recession is closing in. Now remember, at the height of 2008, going into 2009, we were approximately at 1.52. We are currently at 1.4. Prior to 2008, we were currently at about 1.27. So you can see we are on an upward trend, and we are getting close to that period of a major collapse of the system. Because if we take it further and we go back to 2001, we were at 1.42. And we're at 1.4, and in 2001 we had a recession. 2008 we had the Great Recession, and now it's being pumped up, and we're almost at the level of 2001, approaching 2008. We're back to where we started. The only thing that has changed since 2008 is how the central banks manipulate the economy and how well they can create the bubbles, how well they can keep the illusion alive, because everything else is falling apart. Now, the Empire Fed miraculously surged to the most since 2010. They were expecting a negative 10.5, and then all of a sudden, out of nowhere, it went all the way up to 0.62. Now, this kind of looks like a dead cat bounce, and most likely the next month we're going to see this drop quite a bit. What's very interesting about this is that we had this rise in the Empire Fed manufacturing, but the number of employees dropped once again in a 7-month contraction. So what is going on there? Most likely it's a dead cat bounce, and we'll see this drop dramatically next month. Now, the Baltic Dry Index is starting to slow. It has reached 396. And as this week goes on, we'll have to see if it starts leveling off. And of course, with the corporate media, the U.S. government, the talking heads will call this is the new normal now. This is what the recovery looks like. And we're going to have to watch that very, very carefully. Bank of America, they are out there and they're saying the smart money is leaving the market altogether. They're saying buybacks by corporate clients have accelerated last week to their highest level since August and are tracking above levels we saw this time last year. So smart money sold their shares to corporations where they're buying back their stock. This is what we're seeing right now. And what does that tell us? It tells us that they're manipulating the stock market. And you know what happens when the whole thing falls apart and all these companies own their own shares? The whole thing is going to fall apart. This is where we are headed right now. Now, Bank of America is saying their clients were net sellers of U.S. stocks for the 7th consecutive week. Net sales of about $3.7 billion were the largest since September and led by institutional clients. Hedge funds, private clients were all net sellers. And we see that they were selling and corporations were buying. And this is what keeps the market propped up. Now, very interestingly, last week, European Central Bank Mario Draghi announced a much bigger and wider-ranging stimulus package that basically anyone expected. They didn't expect this at all. Now, the ECB is buying bonds. But as they buy these bonds, this has no impact on employment, business investment, inflation, lending, or growth. It has nothing to do with anything. It has to do with manipulating and keeping the market alive, to keep this illusion that we've been recovering. Now, what he's doing right now, it's creating a temporary incentive for corporations to buy back more of their own shares while providing more cheap cash for banks to roll over their debt, which otherwise would have dragged them into default. So Draghi turbocharged QE, and he shifted more cash into overpriced financial assets while perpetuating the illusion that the EU banking system is still solvent. Well, corporations don't expand their operation or hire more workers when demand is weak. And demand is weak, mainly because central banks have worked with their government counterparts to keep it weak by slashing deficits and intensifying austerity. So corporations only have one thing or two things to do: lay off people, buy back their shares, cut costs, because they can't be profitable. And the ECB, the Fed, they know this. They know that consumption in the Eurozone is shrinking, not expanding. And the reason it's shrinking is because unemployment is high. Unemployment is high, and they're forcing governments to push austerity to keep inflation low. Now, as long as inflation stays low, they can provide cheap money to Wall Street. So Draghi's corporate bond buying program is actually another handout for Wall Street. Wall Street was the single largest source of bond sales this year. It looks like retail investors are calling it quits and cashing in, and companies are buying back the stocks to keep this entire illusion alive. So corporations are forcing the market higher by buying back their stocks. The retail investor is getting completely out of the market because they're not optimistic whatsoever. Profits are declining, and there's no way out of this, because sooner or later, this whole entire scam, like every other scam, comes to an end. It will end, and it will end in a complete disaster. We've seen this time and time again. And what they're doing at this point is they're trying to keep this illusion alive, because they need to bring down the market, the economy, on their own terms. They don't want a black swan. They don't want something out of left field. They want it controlled when they're ready, because the blame needs to be on a third party. It can't be on everything that they've been doing, because you know what's going to happen. Everyone's going to turn around and say, all this that you did not help any of the countries. It did not help any of the people. All the austerity that you told us that we had to do did not work. All these people out of work did not help. All it did was keep the illusion alive. Period. That's it. And we can see from the economic indicators that we've been looking at, not just today, but if you go back, you can see slowly but surely how everything is declining. How everything is flashing red signals that we are in recession/depression territory. But you know the government, you know the central banks, they're never going to admit this. They're going to continually tell us that everything is fine up until the last second. Think about 2008. What did they do at that point? They never admitted that, look, we're in a recession, depression, until after the fact. And by that time, it's too late. So if we look at the economy now and everything that we tracked, we see we're headed in that direction. Actually, we're already there. They're just waiting for that big bang to say, yes, we're in a depression, we're collapsing. But by that time, it's too late. By that time, everyone's going to be scrambling. By that time, people are going to say, what just happened? And this is where the situation gets really bad, because when people do things out of fear, this is when you see riots. This is when you see people running to get supplies. This is when you see people trying to buy gold and silver, trying to hoard anything they possibly can. This is when you see companies all of a sudden come out of left field and say, we need to lay off a lot more people. We saw it happen in 2008. But this time, they can't pull the same tricks. This time, there are no bailouts. This time, there's only bail-ins. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.